sector, every industry, every company. And those companies not embracing it the way they should are going to lose out competitively. So we're very excited about that source of deflation because it will cause a boom. So that's a deflationary boom. We think that the ramifications of this good deflation are going to include creative destruction, the disintermediation or disruption of the traditional world order. And we think that roughly 50% of the S&P 500 is at risk of creative destruction, some more, some less, but 50%. And what does this mean? What we think is going to happen here for those companies who spent the last 20 years catering to short-term investors who wanted their profits and wanted them now, companies were leveraging up to buy back shares, pay dividends, and they were not investing enough in innovation. In fact, many didn't take seriously the idea that innovation was a threat. I know when we started ARC in 2014, auto manufacturers, auto analysts thought, this was something for the mid-20s, maybe. And we were looking at the cost declines in battery pack systems, and we were saying, nope, this is happening now. And now we see auto manufacturers scrambling, and we would say they're scrambling for dear life. So we're going to see a lot of that in financial services, energy. So the two sectors that have done best this year, we believe, are two of the most vulnerable sectors. In the energy space, again, up 40% year to date. We think that electric vehicles, and especially autonomous electric vehicles as they launch within the next few years, are going to put a big dent in oil demand. And within financial services, we see digital wallets evolving so much faster than I think anyone could have dreamed. China showed us the way through WeChat Pay and Alipay, and now Square's Cash App and Venmo are moving so quickly that their user base has scaled well beyond JP Morgan's customer base in just a few years, in the last 5 years, whereas JP Morgan got to this level one acquisition at the time. The digital wallet evolution or revolution has gone viral, and there's a social networking element to it. So very interesting space. And so financial services buyers beware. So that's the bad deflation. Those companies that are too leveraged and have products that will be obsolete are going to have to sell those products at a discount increasingly in order to service their debt. So good deflation on one side associated with an innovation, and bad deflation associated with the creative destruction caused by innovation. The third source of deflation that we believe will take place maybe toward the end of this year, probably more likely next year, is commodity deflation. We believe that there is a lot of double and triple ordering taking place right now, and companies never quite know if it is double or triple ordering. I think supply chain management systems are getting better, so maybe it won't be as bad as it has been historically. But we do think that inventories will build to a level well above demand sometime next year, and that the unwinding of them will cause an unwinding of commodity prices. That said, we want to keep an open mind here. When I see a breakout from a 20-year base, as we've just seen in copper, I pay attention. Now, on oil, we have not. And in fact, $140 was the peak in '08, and every peak since then has been at a lower level. So right now we're at 60, and I believe the last peak we saw was in the either high 70s, low 80s. So I'd be very surprised if we go above that level. If we do, then we will, score another one for the inflation risks are picking up. The other thing we're watching is the dollar. To see the dollar break down would be somewhat concerning. Now, the dollar is priced against other currencies. So part of that is a function, perhaps, of our monetary policies relative to those elsewhere in the world. And just on that note, I will say the country that has handled this crisis the best in terms of not throwing money at it willy-nilly is China. And I think that will accrue to their benefit in the years ahead. So I would say watch that space as well. So with that, I just wanted to call out some of our thoughts. We do believe deflation is the bigger risk. The reason I like being on that side of the bet is that it seems like everyone is on the other side. And usually, if that is true, then if we're wrong, then inflation has been or is being discounted in the market right now. So we'll be perhaps uniquely wrong. And it's good to be uniquely wrong. If everybody else expects one thing, then it's probably getting priced into the market. But I think these three sources of deflation are going to throw economists off. As I said, I remember feeling very confused in the '06 period. Interest rates were doing this while were going down, while commodity prices were going up. And so it's at these times that if you do take a stand, differentiated from the crowd, for good reason, not just to be contrarian, the payoff can be enormous. And in terms of the recent behavior of value stocks, especially those that we believe are in harm's way, compared to the severe drawdown of innovation-oriented stocks, I like that setup very, very much.